China PMI has improved according to the latest HSBC Flash China Manufacturing PMI, which came out at 49.5. But technically, while this is still a negative reading, it seems to have been received in the markets as a positive signal. Joining me now to discuss China alongside other emerging market economies is Tim Condon, Chief Asia Economist for ING in Singapore. Tim, tell me, are things looking up for China? Is this further evidence that China is heading for a soft landing perhaps? Or should we take this reading with a slight pinch of salt?
HSBC PMI that we're talking about here looms large now, in even larger than the official PMI. People do take it seriously, and it's fallen for the last 2 months. So that the tick up in the June reading was seen as a as a sign of hope, and it was pretty much across the board strength by subcomponent of the PMI index. So I think markets are taking it as a indicator of a soft landing in China, where a soft landing is conventionally understood to mean that GDP growth will accelerate in the third quarter. In other words, second quarter was the bottom for GDP growth, and this is a hopeful sign that soft landing that we're hoping for is indeed going to materialize.
Does that go along with your view? I mean, how confident are you in the Chinese economy? Do you think China is at the bottom of its economic cycle now, hence expecting a rebound and more balanced growth towards the end of this quarter onwards?
That is my baseline scenario. The confidence I have is mostly on policy. The authorities began to turn more accommodative. The monetary policy began to turn more accommodative last December, when they made their first cut in the required reserve ratio that banks must maintain, and they've done 2 more since, for a total of 1.5 percentage points. So the central bank has also cut the policy interest rates on loans and deposits 2 times this year, in June and then a little bit later in July. And these cuts have been asymmetric in the sense that they've cut the lending rates more than the deposit rates. So it does seem as though policymakers' financial policy is in play to boost growth, and they have considerable scope or headroom to provide further stimulus if needs be. At the same time, more stimulus may be needed, particularly given the hawkish comments that the authorities continually make on the issue or the subject of housing. They certainly seem determined to prevent housing prices from moving higher.
Okay, so you think there is a call for further monetary easing. If that is the case, when do you think this could be put in place?
I think imminent on the next cut in banks' required reserve ratio. Short-term money market rates have moved up. That typically is a sign that interbank liquidity has tightened, and that's the kind of thing that would be alleviated by a cut in the so-called RRR, the triple R. So yes, imminently on that, and I think the in terms of the other instrument, the policy interest rates, deposit and lending rates, I think the authorities will be data-driven. They'll move if they see something in the data that leads them to think that the time is now.
Well, several smaller emerging markets central banks will hold meetings this week on monetary policy, following a surprise rate cut in South Korea earlier this month. How much room, Tim, do emerging markets like these have to cut rates at the moment?
Well, in my opinion, they've all got considerable room to move, and the very deliberate pace that we're seeing these moves, which we're seeing them move, is to me a surprise. They, I think, are failing on their growth mandate, and the evidence of this, I think, can be seen in Korea, where bond yields have simply followed the policy rate lower. 5-year Korean Treasury bonds are now trading below actually the 3% policy rate, which is a sign that not only do they expect the policy rate to fall, they expect it to put the new floor under the 5-year government bond yield. And monetary easing should actually raise bond yields, not cut them and not reduce them. So that's a sign that I think monetary conditions in South Korea remain overly tight, and the central bank could cut considerably more. The policy rate's at 3%. Why couldn't it go back to 1%? It actually is a mystery to me. But it's not something that's limited to emerging markets. I think we can look at the advanced economies, and I think people are looking at the advanced economies and scratching their heads on the same issue.
Finally, Tim, we spoke back in June about the BRICS nations. A majority of analysts I've spoken to are still estimating a significant decline in performance for the BRICS, especially as the European crisis weighs on commodity prices. Also, the Brazilian outlook for one is again looking uncertain, is it not?
It is, and I think it's very difficult to be optimistic about the BRICS. I think that the linchpin here is China. I think that there's China that is supporting the kind of renaissance in the emerging world through its commodity imports. And if people are not confident that China is going to be growing solidly, then it's very difficult to be confident about the other BRICS. The Chinese stock market is indicating that the economy there is not out of the woods. It hit a post-global financial crisis low yesterday. It barely eked out a gain today on the better than expected PMI numbers, but that market is clearly signaling that there's a clouded outlook for the Chinese economy, and I think that overhangs emerging markets generally, BRICS in particular, and explains why advanced economies, particularly the U.S., is outperforming emerging market equities.
Tim, thank you again for joining me and sharing your outlook for the BRICS and other emerging market economies. Now, we've got lots in store for you today on Dukascopy TV in terms of financial news and updates, so make sure you stay tuned with us. But for the moment, goodbye.